For more on this, I'm so excited to bring him back. Former chief economist at the IMF, Simon Johnson, of course, a professor at MIT Sloan and co-chair of the Systemic Risk Council. Simon, thank you for waking up early again to talk to us about what's really happening here. Is this a one-off event, as we just heard, or do you think there's more going on here?
Oh, there's a lot more going on, Andrew. I think there's concern about what's on the asset side of banks' balance sheets all around the world, particularly this hold-to-maturity category, which is how Silicon Valley Bank got into trouble. And there's plenty of hold-to-maturity on the balance sheets of European banks.
So when you look, though, at the Credit Suisse situation, as I think we're all trying to just at least resolve that in our own minds, the government now backstopping that firm and at least taking some of the counterparty risk off the table, how concerned are you about the other European banks in terms of spillover? I mean, that was something that we just heard about. And then the second piece, of course, is spillover contagion here, though obviously the contagion we already have here might be spilling over there.
Well, first of all, I think the situation in the U.S. is really under control at the moment, Andrew. I think the Fed's window with a negative haircut is quite a remarkable intervention. I think they've done enough to reassure depositors. Personally, I think they should go further and also charge deposit insurance for everybody who gets ex-post insurance. The key question, Andrew, is actually the euro area and what the European Central Bank does. I think we can take Credit Suisse off the table. Swiss National Bank, thank you. That's when your bank is too big to fail, you have to prevent it from failing. So they just did that. But what's the attitude within the Eurozone? This is where we've seen various fault lines before, right? In the recent past, Andrew. And I think this is the concern for the next days and maybe weeks.
So but help me understand this piece of it. When you just talked about in the United States saying you felt pretty good about sort of where we are, deposits, preventing deposit flight and the like. We have this implicit, and it's implicit, not completely explicit, effectively guarantee on deposits. Do you think that's going to get tested?
Yes, I think it will get tested, Andrew, and I think testing is the right word. So we'll see exactly how the authorities respond. Much better than this ex-post improvised implicit guarantee, for which people don't pay, which is massively unfair. You should have something ex-ante, a proper deposit insurance scheme that covers, let's say, all individual money and all corporate non-financial sector operating cash and so on. That was the cornerstone, of course, of the fears of the effect on the real economy.
How is that going to work? Who's going to pay for it? It by default means that the smaller and regional banks are going to be paying more because they're going to have to pay into some kind of insurance program. Some of the larger banks are going to have to do that, I imagine, as well. There's been a lot of bipartisan support, if you will, for bailouts and rescues in this country. There's been a lot less bipartisan support for regulation and the like.
Well, we can get to regulation, a separate topic. But right now, Andrew, 10 trillion of insured deposits is paying insurance, which is covering 18 trillion of total deposits. So why are the 8 trillion of uninsured deposits getting a free ride? That's massively unfair. It doesn't make any sense. So everyone who has a deposit, let's say everyone who has a demand deposit, should pay insurance, and the insurance should be the same across everyone. None of this cap of 250,000 doesn't make any sense in the modern economy, and we found that out on Friday and Monday, didn't we?